Today we explore who benefits from cheap silver and how the silver market could unravel if the silver giants are truly awakened. So let's dive on in. Now, this channel provides global macro insights and champions the importance of sound money in a world gone crazy, so please do consider subscribing. So let's start by exploring who benefits from cheap silver. And this most obviously breaks down as the Fed and the government, the banks, manufacturing nations and consumers. Let's just briefly explore each of these, starting with the Fed. Now, gold and silver, of course, are natural enemies of fiat currencies, and by keeping silver undervalued and fiat currencies overvalued, it creates the perception that fiat currencies are the more valuable form of money, of course. What's more is that volatility within the silver market also discourages investment. So when you see a big price run up, as we saw on back at the start of February, we then see the price come back down, and that discourages any means of actually wanting to invest. Now, that volatility is important because when it comes to currency crises, the most common way of staving off any currency crisis is through the use of higher interest rates. And so moving on to the banks, according to the wonderful work of Ted Butler, there are significant naked short positions when it comes to the COMEX silver market. There's a high concentration of net shorts, that is 4 banks amounting to 300 million silver ounces, and 8 traders are net shorts, according to Butler, at 400 million ounces. So this is absolutely significant, and they have no interest in seeing the price run up when they cannot actually back up their positions. And we can see the size of the short position in the silver market here based on the 4 largest and the 8 largest traders from a wonderful chart from Gold Charts R Us. But if the silver price were to run up, it also threatens bondholders. And given that banks hold a lot of US treasuries, then it does mean the value of treasuries would be greatly undermined, because a silver price appreciation reflects a depreciation of the currency. This would mean that it's entirely plausible that we'd see a fall in demand for bonds. A fall in demand for bonds would consequently lead to a weakening of bank balance sheets as the real value of those positions deteriorates. Moreover, as we've seen with the gold markets, that overseas bondholders would become less willing to hold US treasuries if silver and gold prices were actually increasing and were allowed to increase. That would actively discourage other authorities from holding US Treasury bonds, which at least offer some sort of yield, which gold and silver of course do not. But there's also a key benefit of cheap silver to manufacturing nations and firms that require heavy supplies of silver. Now, it's alleged that China is a significant silver buyer, and certainly there's good data to support such a position here, as we'll consider in a moment. It's a crucial asset for value-added manufacturing, of course, and a cheap silver price ensures competitiveness and allows the gain of market share at the expense of other nations which might not be able to access such higher value-added manufacturing, or may not be able to buy so much in bulk. But the consequence is also a benefit to consumers who can enjoy cheaper priced goods because silver prices are kept low. And of course, many of these items are strategically important to the prospect of this great reset. If you consider smart goods, 5G and connectivity, electric vehicles, green energy as prime examples there. But if we concentrate on the actual silver market, it is composed of bifurcated market demand, and that comes through 2 key forms. There is the investment or monetary demand for silver, and then there is the industrial demand, and that is where the reliance is really felt upon paper future markets. And so when it comes to the physical demand, the physical investment demand, the monetary demand, it tends to be far more erratic and of course goes through a cyclical process as people begin to actually question fiat currencies. So at times of sheer monetary excess, then it means that gold and silver can be a real cyclical juggernaut. Now, demand ordinarily could be quelled with higher interest rates, and we saw this back in the 1980s with Paul Volcker. But this is not possible with US debt at 130% of GDP. So the easier option is to short future contracts, that is to sell future paper contracts. This has the impact of inducing volatility and discourages investment, because these paper contracts can be repeated again and again and again. And as long as no one stands for delivery, well, it's not a problem. But when it comes to industrial demand, this tends to be more consistent, and crucially, when they buy future contracts for silver, they will actually want to collect on those demands. But the futures market does offer price stability and confidence for firms, which is absolutely crucial to their business models and cash flow forecasting and so on. But when it comes to the type of demand that we're concentrating on here, this is where now silver becomes highly inelastic in terms of its demand. It is a necessity item for such industries that are reliant upon silver as a key component, and this means that if they are uncertain at all of the prospect of being able to access future silver supplies, then they are likely to increase their future contract purchases, and to do so in sizable amounts that would ensure that they have ample stockpiles to get through any periods of shortages. Previously, we've looked at how this year we are really likely to see a very, very high and significant deficit of physical silver. And so this is where it really comes down to awakening the silver giants and how the market could unravel. If firms perceive uncertainty over their future ability to actually get hold of physical silver, they are likely to start panic buying. Panic buying of future contracts by industries means that they will collect and accept delivery of those silver contracts. But what's more, this could be reinforced by panic buying of future contracts by countries, as silver remains a strategic asset. And just look at what we've previously considered when it comes to China and the way in which they have been encouraging their citizens to both invest in gold and silver. Can you imagine on their state-sponsored telly, they've had documentaries about why it's wise to invest in precious metals. Just cannot imagine that ever happening over here. Meanwhile, China set up a sovereign wealth fund back in 2007 to help the country make use of its considerable current account surpluses that it's enjoyed from its significant trade positions. This sovereign wealth fund has a clear remit to ensure that they have ample supplies of strategic resources. And as has been recently pointed out by SD Bullion, Chinese silver production plus the net import levels mean that China seems to have a highly significant reserve position of silver. And so it's interesting to consider that other analysts will actually raise doubt over the Silver Institute figures and say, well, there is enough physical silver. But I would say there isn't enough physical silver at the current price, because how can you actually increase current supplies? Well, it would be increasing the amount of recycled silver. The only way in which people will actually start to recycle silver or to sell jewelry or even silverware is if the price is high enough. Clearly, right now, the price isn't high enough, and the prospect of deficits within the silver market, as we've looked at previously, really does suggest that there is an increased likelihood that we are going to see industries and potentially countries and their sovereign wealth funds actually buying up increased future contracts for silver. And I think this is a fascinating development which is going to apply further pressure on the COMEX market. But of course, we also know that when it comes to silver and the investment demand, well, JP Morgan likes to pull the wool over our eyes there. Now, the SLV ETF has come under a lot of intense pressure recently. Ronan Manley's been doing some wonderful work analysing the way in which the prospectus information has been changed and how the actual quality of the SLV ETF is being further diluted. What is great to see, though, is that there is a clear dislocation developing between the SLV ETF and its performance against that of the PSLV ETF, which is Eric Sprott's silver ETF. And you can see the percentage gains over the last month are far, far greater for the PSLV than they are for the SLV ETF. And so to my mind, it seems very likely that if we see more and more firms buying up future silver contracts and standing for deliveries, that it poses an even greater risk to the COMEX system. Because what happens when eventually that deficit point is reached and no more silver is available? That is when the system begins to really unwind. What do you think? I'd love to know your thoughts. Do let me know in the comments below. Thanks so much for watching. Do consider subscribing, and I look forward to seeing you again next time. Bye bye.